Welcome to another video. This topic is going to be a vertical spread series. And you'll remember a vertical spread involves a long and a short position in two options, both calls or both puts. So for example, you're long one call, short another call with a different strike price, but the same expiration date. Or perhaps you're long one put and short another put with a different strike price, but the same expiration date. Those are vertical spreads. And now we're going to do something with vertical spread series. That's quite interesting. So we start off by looking at this data. This data is showing the bid and ask prices for calls and puts with the strike prices as indicated down the middle. At the time this data was obtained, the underlying stock was bidding 49.07 and asking 49.08. Okay? Now, and here's the data. Now, what we are going to do is we're going to create vertical spreads. Call bull spreads to be specific. And so, for example, we're going to be buying the 37 call and writing the 38 call. That will be a 37 and 38 call bull spread. We'll also be looking at buying a 38 call and simultaneously writing a 39 call. That will be the 38-39 call bull spread. Okay? And so we have this series of vertical spreads we're going to examine, and we're going to make some pretty interesting observations. Remember, if I buy the 37 strike call with a market order, I would pay $12.11, and if I wrote the 38 strike call using a market order, I would receive $11.06. That would be a very bad idea, because you'll remember the maximum possible value for a 37-38 call bull spread is $100. And obviously, keeping in mind these are per share equivalent prices, I'd be spending more than $100 to buy this bull spread, so you'd never do that. So in these, we'd have to, if we wanted to trade in the 37-38, we'd have to use a limit order, in the market limit order to be specific, and specify prices for the most likely simultaneous purchase of the 37 strike and sale of the 38 strike, such that if we get what we want, if we get the call bull spread, we pay less than $100 for it. Okay, so let's go down here to more realistic. Let's talk about the 45-46 call bull spread. So we'd be buying the 45 call bull spread, paying $425, and writing the 46 strike call bull spread and receiving the bid $331, and that is a net outlay of $94 for the 45-46 call bull spread. Okay, so now the base unit of analysis becomes the spread, the bull spread, not the 46 call, not the 47 call, but the long position in a 46 call combined with a short position in a 47 call, known as a call bull spread. Okay, so I do the calculations to gather all those costs, and those that data appears in this column right here. So here we have the call bull spreads. Low strike price, X low, X high is high strike price. And then we talk about the net debit. It's the ask for the low strike that we're buying minus the bid for the high strike that we're writing. And here's the 45-46 I just talked about, and you see that difference is $94. So the cost of the 45-46 call bull spread is $94. It has a maximum possible value of $100, and it's going to be worth $100 at OE, option expiration, if the stock price is then 46 or higher. Make sure you can figure out why that is the case, as described in earlier videos. On the other hand, if the stock price at option expiration is 45 or lower, it will be worthless. Both options will expire worthless, since we own the 45 and have written the 46, they both expire worthless, and therefore we have no value to recoup, as well as no buy to close for the 46. But so if we paid 94 and the stock price at option expiration was below 45, it would be worth nothing, and we'd lose our $94. So what this indicates is that our maximum profit, since the most this 45-46 bull spread with calls can be worth is $100, our maximum profit is $6. I'm ignoring commission right now. Okay, I'm ignoring commission right now. And so, in fact, since the bid price is now $49.07, and we earn our maximum profit when the value of the call bull spread is 100 or higher, that means stock price could fall from $49.07 down to $46, and we'd still earn our maximum profit of $6. And that means the stock could fall $3.07. So our maximum profit safety buffer is $3.07. Beside that, I calculate our break-even safety buffer, and that's going to be 6 cents higher. 6 cents higher, $3.13 decrease that we could withstand and still break even. Obviously, we'd be giving up our profit, but we'd break even. And here I'm showing the maximum HPR that we'd earn. The analysis here that I talk about in the text is a 33-day horizon. So we could earn 6.38%. Pretty impressive for a 1 month return. So what we're showing here is that if we go long a 45 call and short a 46 call and pay 94, ignoring commissions at the moment, if the stock price was 46 or higher at option expiration, we would earn a 6.38% return in 33 days. And you have to admit that's quite good. Okay? And what if we bought a 46-47 call bull spread, buying the 46, rating the 47? Well, the net cash flow there to open is $88. Okay, of course it's less expensive because it's less likely to be a winner. Because in order for the 46-47 call bull spread to be worth $100 at option expiration, stock price has to be 47 or higher. And the probability of the stock price being 47 or higher is of course lower than the probability of the stock price being 46 or higher. So this is a riskier call. This call bull spread, the 46-47, is less likely to end up being a winner, that is being worth $100, because stock price has to be 47 or higher at option expiration for it to be worth $100, and therefore it's cheaper. It's less likely to be the $100 winner, therefore it's cheaper. Cost us $88 to buy it, implying that we have a $12 profit. Our maximum profit safety buffer, stock price could fall from $49.07 down to $47. That's $2.07. 12-cent difference. Our break-even safety buffer is $2.19, and we could earn if the stock price was 47 or higher, and this call bull spread was worth $100 at OE, we could earn 13.64% in 33 days. Pretty interesting. And so on as we go down here. If we were to buy the 47-48, remember it's going to be worth $100. We're long the 47, short the 48. It's going to be worth $100 at option expiration. The stock price is 48 or higher. Of course, the likelihood of that being the case is lower than the likelihood of it being 47 or higher. And so this is going to be cheaper. This was $78 via the interaction of demand supply forces in the market. This will be cheaper, $78. And our maximum profit then is 100 minus 78, or $100 maximum value minus the 78 we paid, or $22. Stock price could fall from $49.07 down to $48, so we have $1.07 maximum profit safety buffer. We'd still earn our maximum profit even if the stock price fell $1.07. And if the stock price was worth $100 at OE, meaning if this call bull spread was worth $100 at option expiration, meaning the stock price was 48 or higher, we could earn 28.21% in 33 days, and you'd agree that's pretty good. And this chart continues down. So I'm going to leave the chart here for a second. I want you to study that. Down here, when you have negative values for maximum profit safety buffer, it just means that the stock price has to rise because you're starting kind of behind the 8 ball. Okay, so this is very interesting. Now we've ignored commissions here, but we've seen that it's logical that these call bull spreads become cheaper as the strike prices chosen get closer to the current stock price. Okay, well now I'll move down here to another chart. This chart takes into account commissions. And back when I wrote this book in 2010, the cheapest commissions I was aware of for a real broker were $1 per contract. And so with, let's say, a call bull spread, we were buying the 45, buying the 44, for example, writing the 45, and that's to open. And then worst case scenario, to close, we have to sell the 44 and buy to close the 45. That's 4 commissions at $1 each. So that would be a $4 commission. So even though it costs us $98, instead of having a maximum profit of $2, we have a maximum post-commission profit of minus $2, because positive 2 minus the $4 in commissions, the worst case scenario would be minus 2. So this table here takes into account commissions at $1 per contract, both to open the position and to close for both options. So left it there for a second for you to think about. Nowadays, there's many option trading websites where you can trade for free. Okay. So now let's go down here, and here's an interesting observation. Let me go back up here and make one other observation. The observation that I want to make right quickly is that the existence of commissions really reduces the number of call bull spreads which would allow for a profit. So here, the first one that's profitable is the first one that's potentially profitable is the 45.46. But back when we ignored commissions, the first one that was profitable was the 43.44, potentially profitable. Okay, so keep that in mind. The existence of commissions reduces the number of call bull spreads in the series that would be profitable. Okay, now we want to make the big observation. Here it is. Now I've considered commissions, but now I have here for the 41.42 through the 54.55, I have the net debit per share. If you bought the lower strike, call at the bid, if you bought the lower strike, call at the ask, and you wrote the higher strike call at the bid. So here this 104 again, remember, is buying the 41 call at its ask and writing the 42 call and receiving its bid. $1.04, you'd never want it. But now we talk about creating midpoints, okay? Midpoints. Instead of taking the bid and the ask, the ask for the 41 strike and the bid for the 42 strike, I start off by calculating the midpoint for both the 41 and then separately the 42. And then I use those midpoints, almost assuming an in the market limit order would end up executing for both. Okay? And then when you do that, you get what the price would be. I call it the midpoint difference. And we're going to see in a moment that I'm also describing it as the market consensus probability that at option expiration, the stock price will be greater than or equal to the strike price of the option we wrote. Here with the 41.42, it's greater than 42. Here with the 42.43, this would mean stock price at option expiration greater than or equal to 43, and so on. So when I use the midpoint of the options, instead of the actual bid and ask, if I use the midpoint of the bid and the ask for the 41, and then calculate the midpoint of the bid and the ask for the 42, and then I assume I buy the 41 at the midpoint and write the 42 at its midpoint of its bid and ask, then it would cost me 99.5 cents. Pretend that's possible. Since this can be worth at most $100 at option expiration, which on a per share basis is $1, paying 99.5 cents indicates that it's highly likely stock price at option expiration will be 42 or higher. So paying 99.5 cents is fair. But note we'd have to pay $1.04 with just looking at the buying at the ask for lower strike and writing at the bid for the higher strike. So here we've worked away that problem, but then we still have this commission problem to deal with, and that is really going to chew away at our profits. Okay, so let's go down here to things that end up still being profitable. Here, the 45, 46. It's going to cost us 94, but if I use the midpoints, which can be interpreted, this is very important, the midpoints can be interpreted as the market consensus probability that stock price at option expiration will be greater than or equal to 46. That probability is 91 cents. Now, big point here, very major point. Notice, because of the existence of bid-ask spreads, excuse me, we could be required to pay as much as 94 cents to get something that has a probability of winning of 91 cents. That's big, and you don't want your odds reduced like that, okay? So the most that this 45, 46 call bull spread can be worth for the contract is $100, and because this is per share, it's $1, and therefore 91 cents is what it should cost us to buy, and that's the probability, but it costs us 94. Right away, we're losing. It's like going to Vegas and gambling. Right away, the odds start working against you, okay? But even with this, we still have a maximum post-commission profit of $2. If you're not paying commission, then your maximum profit is $6, okay? If you could get the 91 midpoint price, your maximum profit would be $9 per contract. Since the multiplier for the contract is 100, it'd be 9 cents per share, okay? And I would like you to study this table and pay particular attention to this column here. Very important. The idea, again, is that when we use midpoints and then pretend that we can trade it at the midpoint of the 41, for example. We buy the 41 call at the midpoint of its bid and ask, and we pretend we can write the 42 strike call at the midpoint of its bid and ask. That would be 99.5 cents, okay? Down here with the 45, 46 call bull spread, we're pretending that we can buy the 45 call at the midpoint of its bid and ask and write the 46 call at the midpoint of its bid and ask, and that would get us a price of 91 cents for the call bull spread. So please pay particular attention to this table, and that's the point that I'd like you to realize, that when we have a vertical spread series, we are able to see the market's consensus probability of the probability of the stock price being higher than the strike price of the option we wrote right in front of us. And not someone's opinion, not an individual person's opinion, but rather the collective market's opinion by looking at the, because these data here are based upon the bid and ask quotes in the market. So we're letting the market speak as to probabilities. And that is pretty powerful. So I call this a vertical spread series, and I'd like you to study this chart here. You can kind of ignore the concept of commissions now, but it's a very, very interesting concept. Now, how can one apply this? Well, if you happen to become a registered investment advisor someday, or if you happen to work for one, then you can use this not necessarily to have your clients invest their money in call bull spreads, although you may choose to do that, or your client may choose to do that. You can use this to ascertain some understanding of your client's risk tolerance. For example, if a client says, you know, I like this 96% probability, I'd be willing to put 5% of my portfolio into that. And another client might say, no, I need this probability. And therefore, the one person is willing to take a much smaller gain, even though here it's negative because I'm considering commissions. You get my point. Okay, so a neat thing about this is it gives us some insight into investors' tolerance for risk. And you just ask them, hey, which one of these do you feel comfortable with? And another aspect of that will be, what proportion of your wealth are you willing to put at risk? Remember, if one of your clients goes long the 45, 46 call bull spread, lots of them, if the stock price at option expiration is 45 or lower, they're going to lose every penny they invested. Okay? If the price is if the price ends up being 45.50 at option expiration, then this 45, 46 call bull spread is only going to be worth $50. And if they were lucky enough to pay 91, they're going to lose $41 per contract. So they're still going to lose. Not everything. They'll have some wealth at the end, but they could lose. So the neat thing about this is it allows you to have some insight into clients' tolerance for risk. That's all I have for this. I hope you found it interesting. Thanks very much for watching.